Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C from CNBC-TV18 Prime, Ionic Wealth Studio. I'm Manisha Gupta, back with your daily dose of commodities, crypto and currencies. Well, a quick look first of all at the global equity markets, where there have been strong gains across indices on the Wall Street on Monday's session. Well, the tech-heavy Nasdaq soared 2.7% to record its best day since the month of May as tech plays rebounded from what was a rocky month for the sector. The blue-chip Dow Jones closed higher by almost 200 points, and it seems to be a similar story unfolding in the Asia-Pacific, with Hong Kong and Chinese markets leading the gains. Back home at the Nifty, well, that one is trading just below those 26,000 level marks. A quick look at the crude oil prices and a slew of triggers hinting or hunting for attention in the crude markets as investors weigh changes of a rate cut in the U.S. markets there against the prospects of a peace deal between Russia and Ukraine that could lead to easing of sanctions on key producer Russia. The US dollar index, in the meanwhile, is trading steady ahead of that all-important macro data that seems to be coming in from US today and tomorrow. For today, it's going to be about the retail sales, home sales, PPI data, consumer confidence print as well. And as you can see, that is dollar index trading above 100, rupee as well, slightly stable after that all-time low that we saw on Friday. Joining us to talk all about that is Sakshi Gupta. She's Vice President and Senior Economist at HDFC Bank. Sakshi, hi, thank you so much for joining in. First of all, your sense on the rupee and the way we've seen a very, very sharp decline come in, 4.5% down for time till time. How are you looking at almost nudging 90? Do you see that happen in this year itself?
Hi, thank you. Good afternoon. Thanks for having me on the show. Well, look, talking about the INR, I mean, this year, the story on the INR, at least over the last, couple of months, has really been a play on the market waiting for, a trade deal to come through with the US, right? I think that has been the biggest influencer on how the USD INR pair has moved. Until the time that, I think that we do not get any positive announcements around that, I would still expect, the rupee to remain under depreciation pressure. That being said, of course, the RBI has been very, very actively, trying to curtail sharp volatility in the rupee over the last couple of weeks. And I do expect that to kind of continue. So breaking above or moving towards the 90 handle, at least, in the remaining part of this year, seems to be, a little difficult in my opinion. I do believe that, over the coming weeks, I mean, it's very difficult to, kind of predict when we would get a trade deal announcement. But when that comes through, I do expect that there could be some retracement and gains in the INR. And, this year we've seen the INR kind of underperform, at least over the last few months, compared to Asian peers. And as I said, that's really been a story of the tariff differential. So at least in the near term, I still do believe that there is two-way volatility for the rupee, which will be determined by really the outcome and the pain that you continue to see on the tariff front.
Sakshi, your point is well taken. 90 seems slightly difficult because we've been, in any case, one of the worst performers within the Asian markets there. But as and when that trade deal happens, and that is something that everybody is watching for right now, and then there is some stability and even some appreciation, where do you see, in that case, rupee appreciating up to?
Well, again, it is difficult to kind of predict at this stage where that level is going to be. And the primary reason for that is the timing, right? So if you have another 1 or 2 months where you don't see, the trade deal coming through and the rupee continues to be under pressure, then, very, very sharp, retracements back to levels that we were in perhaps in April and May is going to be very difficult, right? And also I think that, once you get a trade deal announcement and there is some positive sentiment and there are capital flows that come back into equity and debt markets in India, I think that would also be an opportunity for the RBI perhaps to come in and start kind of building its FX reserves yet again, because we must remember that they've been drawing down on that and intervening quite aggressively, as I said, over the last couple of weeks, right? So in that situation, I mean, broadly, at least for this fiscal year, we are looking at 87.50, on the positive side for the rupee, and on the higher side about 89.50, which is a level that it, kind of almost reached to very, very recently. So that is the broad range, at least for now, that we are kind of looking at.
Sakshi, just one more point on the rupee. So I was looking at the data charts here, and in 2020, rupee was at 73. Fast forward to 5 years, and we've almost lost 15 to the US dollar there. I mean, there has been 1 year which was strongly negative, and that was perhaps 2022, where the rupee fell by 10%. Now, on an average, in last 20 years, 3.5% of a depreciation is what we've seen in rupee. The other thing that I'm looking in the charts is that in 20 years, it has only been 5 years that rupee has seen some appreciation. 15 years have been of depreciation. So with the kind of history that the Indian rupee has and the kind of very sharp decline that we've seen happen in last 5 or 6 years, would you see a similar trajectory than going on? I understand 90 perhaps is a possibility next year, but are we really moving way beyond and more depreciation there?
Right. So, while my view, as I said, and we've had this view that, look, the rupee is going to be under pressure, and we've had this view for a couple of months now, contrary to a lot of expectations in the market. But, when I think about a more long-term or medium-term trajectory for the rupee, and you spoke about historically, we have seen about 3.5–4% depreciation in the rupee. Is that something that is likely to continue at that pace? Well, I would have a different view there. I think that the average depreciation that you would see in the next decade or the next 5 years is perhaps going to be slightly lower for the rupee than what we've seen in the past. And there are a couple of reasons for this. I think one is that, if we just, look beyond the current tariff uncertainties, etc., one of the things that have fundamentally changed on our current account deficit, position is that our current account deficit has now structurally come down to, being between 0.5 to 1.5% of GDP. And primary support there has come from the services exports, right, as well as remittances inflows that India has been seeing. And I see this trend kind of continuing, going forward. The second thing is that, in historically, we have been much more vulnerable to any sort of commodity price shock, especially on the oil front. And given the kind of diversification that we have seen in terms of our import basket and gradual move towards, away from fossil fuels towards renewables, etc. I think these trends from a medium-term perspective again speak about the reduced vulnerability on the current account deficit in terms of our import bill. So my assessment would be that on average, the depreciation that you see going forward, would be much lower than what we have seen historically for India.
That point is well taken. Sakshi, also coming on the global cues then, and as you mentioned, trade agreement is going to be one part of that. But the other side really is the longest ever US government shutdown. And today and tomorrow is going to be all about various US data delayed. And then you do not know about the credibility of that one. But that's aside. And you have the US Fed meeting also coming in the month of December. So from these global cues, what is it that the Indian as an economy or India as a market would be watching out for?
Right. I think over the coming weeks, of course, I mean, the most critical thing for our markets and the economy, of course, is, what happens to the, decision at the Fed meeting. I think that is a very, very important, the December meeting is going to be very important. I think the market has been swaying back and forth in terms of pricing in whether the Fed is going to cut rates in this meeting or not. We have seen that, US yields have been relatively firm over the last couple of weeks, in part because you haven't had a lot of data that has given you any idea of where interest rates are moving. So I think this is going to be a very major influence. Beyond that, I think that one of the things, and this is specifically from a rupee perspective, I think that the US economy has actually performed much better this year compared to where, things were being forecasted at the beginning of 2025. right? There are a lot of, with the Fed rate cuts, with a lot of fiscal spending and a lot of productivity gains that are already playing out in the US economy. I think that 2026 again could be, a relatively positive year for the US economy, at least vis-a-vis what is being expected. And I think that primarily is going to be positive for the US dollar index. And in turn, that means that I don't see a significant amount of appreciation in the rupee next year, even if we get a trade deal.
Sakshi, I want to take a step forward now and talk about 2026, because when you look at this year, we've talked about on how GDP could get impacted with those 50% tariffs that we kind of live with now. How would you look at, we still don't know as and when the trade agreement happens. If that happens, I'm assuming you will be changing your numbers. But if it does happen, how are you now looking at 2026 in sense of India's growth, inflation, GDP, interest rates going forward?
Right. So, look, the next year, assuming that we do get a trade deal with the US, and there is some amount of diversification that exporters already start doing, and I think some of it, we are picking up some signals that some of that has already started happening, right, to other destinations. So, if that kind of plays out, I think that at least on the export front, both goods combined with the momentum that we are seeing in services are broadly going to be a little bit more supportive for GDP growth compared to how they have performed in FY26. Overall, for growth, I think that from a domestic economy perspective, clearly we are going to, continue to reap the benefits of, the interest rate cuts, income tax cuts, as well as, the GST cuts that have recently come to through on the demand side. And I do see the rural economy continuing to gain further momentum. So that again is another positive. I would peg GDP growth at this stage for next year between 6.5 to 6.7%. Remember that next year there is going to be a very high base effect, because this year the first half of the year is anticipated to average above 7%. So that is going to have an impact. But overall, I think that given a lot of momentum on the domestic side and slight improvement on the external front, I do see some improvement, or at least growth kind of holding up. On inflation, again, I mean, this year has been, inflation has been coming down and has continuously been underperforming expectations and forecasts. So this year, average on inflation, we are expecting 2%. But for next year, we think that inflation will start rising, and on average, we should see about 4% inflation, which means that, perhaps we get one more rate cut in the December policy. I mean, it's a close call, but it is likely that, we could get another rate cut. But beyond that, I think that on the interest rate front, at least the RBI is going to remain on hold for FY27.
Point taken. Sakshi Gupta, as always, thank you so much for joining in and making sense of what's happening in sense of macro cues and, of course, in the Indian markets outlook as well. With that, it's time for a short breather on the show. On the other side, will be more discussion on commodities and currencies lined up. Don't go anywhere. Welcome back. You're with us on the Big C on CNBC-TV18 Prime. Joining us now on the show is Naveen Mathur. He's Director of Commodities and Currencies at Anand Rathi Shares and Stockbrokers. Naveen, hi. Thank you so much for joining in. And I want to start with gold and silver first, because it has been a very, very strong year. The best since 1979 for gold, best in last 10 years when it comes to silver. So with the 54% of gains that we are looking at in gold and 78% of gains that silver has given its investors in this year, how would you, one, read this year? And would you say 2026, while no one expects that gold and silver will give a similar kind of performance, but would we look at these gains holding and some more build-up coming in?
Well, thank you very much, Manisha. Good to see you're added up cryptos too on currency and commodities now. So coming on to the first time for this show, so I just saw this. Thank you very much for inviting me. I think what you said is absolutely correct. Means that the last 2 years, particularly, Manisha, have been phenomenal for both gold and silver. The last year, we saw around 34-35% of gains on commodities, gold and silver. And this year, as you rightly said, We are currently at around 60% for gold and around 75% on silver. Now, one has to be cautious, means we all know the fundamentals which are driving gold currently. The central bank buying is there. The ETF, the investment demand globally, has pulled up largely, safe haven demand, so to say, from the start of this particular year. And the tariff wars are adding fuel to what the returns have been till now. So I would say 1979 again was a very, very hard inflationary year. 81, the year the Fed did the interest rates to a level of around 21% plus. And those are the things which make gold a good commodity, both as a hedge against the geopolitics and at the same time, the hedge against the inflation too. So I would say, yes, we did had those kind of returns over the last 2 years. But if you really ask me, things would shape up. You won't expect the economies to continue, the global economy or the world to continue in the kind of the uncertainty we are living in over the last 1.5 years post, I would say, COVID and the Russia-Ukraine invasion. So I think, and the Middle East tensions too. So I think lot much would be clearer coming up in 2026. But still, gold, people have now understood gold and silver particularly. And with ETFs in India, too on silver now, I would say that the demand would continue to be. One of the figures which are striking is that in October month this year, we have surged, the gold in imports have surged by around 200% versus the last October. So I think the investment demand, the central bank buying out of the US dollar reserves, the diversification of the portfolio by various institutions, including the central bank, Manisha, would definitely be of the major fundamental, which would help gold to continue with its positive trend. But okay, I don't think so that the kind of returns we have seen this year, as of this point of time where we stand, we will see in 2026.
So Naveen, as an in-house view, what is it that you see in case of gold and silver for prices for 2026? What are your targets or what are the ranges that you're working with?
Manisha, I would talk about the range. It's a very good question. Means we are living in a world which is coming and dependent upon not just on few fundamentals. We are living in a world which is on uncertainty, means any news which is coming in. So if you remember 10 years or 20 years back, we used to talk about currency, demand, supply, festival seasons, China, and all those things. Central banks, the Federal Reserve rates, etc., etc. Other things have changed drastically and dramatically over the last couple of years, and many fundamentals have started playing the role for the bullion sector and therefore the price trends. I would say, honestly, I didn't expect gold to go beyond $3,500 per troy ounce for this particular year, but we did saw 4,380 levels too. So I would say gonna consolidate at around broader range would be around 3,800 on the downside. And we might see 4,300, 400 levels. So $600 range. Currently, we are at around $4,120 per troy. So 3,800 on the downside, Manisha. Or if something comes up really well in terms of the tariff policy across the world from the US administration, then the uncertainty would go a little milder for 2026, and therefore I would say maybe a correction to a level of around 3,600, but 3,800 to 4,400 levels would be on the international markets. India is currently at around 1,25,000 for 10 grams. The downside is restricted at around 1,10,000, and the upside, as I said, is around 130. We did saw 129, 128 levels, which were all-time high last month.
And I mean, that's about gold. That's about gold. But what is it that you're looking for silver as well? Because we're looking at outperformance coming for silver vis-a-vis gold. So not just vis-a-vis gold, but across metal as a sector, across other PGMs like platinum and palladium as well. So silver really is the thing to watch out for.
Manisha, gold-silver ratio played a very, very critical role this year in 2025. Everybody was expecting the silver to catch up the rally, what it missed while gold touched 48 times new highs for this year, calendar year. So I would say a very dynamic commodity. As we understand, it is an industrial commodity, and therefore the usage is 55 to 56% on the industrial metal side. Not much depends upon how the economy play out, the global economy play out, particularly with respect to the tariffs. And I would say the China story, Manisha. That means the government is doing too much with respect to stimulus to be provided to the Chinese economy, but it has not helped so far. And China has come a long way, means the last 2 or 3 decades, last I would say 4 decades, have been too good for China. So kind of consolidation won't be in the driver's place, China for 2026. And I say that India and the emerging market story would be something to watch out for. So overall, if the economy improves, the demand comes in for silver as an industrial metal, the prices can move up because of the deficit we are seeing in for the last 5 and 6 years, the continuous deficits which is building up for silver. So that is one of the major important factors, but 51 to 55 on the upside and downside at around $48 levels.
All right.
But very dynamic commodity means I would say that you should be very cautious while trading in silver. It is better to invest as a portfolio with the ETFs now being there in India.
Naveen, a final question, and this one is on metals. And how would you look at the overall segment for 2026? I mean, after what gold and silver have already done, would you say some money rotating in case of base metal prices in the year to come?
Manisha, we don't have the ETFs. Means if we have those options available, I would say people would surely look into for a kind of an investments in the base metals category. But overall trend for copper, I would say remains positive. We feel that it is neutral to positive. It is steadying at around certain levels with LME. And I would say that more or less it is stable. If I see the LME current prices, they are at around $10,000, $10,860. And in Indian markets, the MCX is at around 1,006 or so. So I think the bullishness is there, particularly for copper. But I don't see too much of steel on the aluminium or other commodities to be on the upside trajectory. Mostly neutral, but copper would be neutral to bullish.
Naveen Mathur, as always, thank you so much for joining in and making sense of what to make in sense of price moves in gold, silver and many of those metals as well. Appreciate your time today. And with that, it's a wrap on this episode of Big C. Thank you for watching.